Greetings, I'm Keith Klein, the host of the VentureFizz podcast, where I interview the most fascinating people in the tech scene. This is episode 383, and today's guest is Rob Biederman, managing partner at Asymmetric Capital Partners. Not too long ago, people didn't really associate entrepreneurship with Harvard Business School, but I feel like a shift started to happen in 2009, 2010, when companies like Birchbox, Runway, and ThredUp were all started by HBS students. The trend continued while Rob was at HBS and started what was called HourlyNerd at the time with his co-founders in 2013, and today, HBS is one of the premier B schools for entrepreneurship. HourlyNerd rebranded to Catalant and is the market leader for connecting companies to vetted independent consultants for right-sized engagements with Fortune 500 companies where proven expertise is required. The company competes against the top strategy consulting firms and has raised $125 million in funding from General Catalyst, Highland Capital, Greylock, Salesforce Ventures, and others. Asymmetric is an early-stage technology investment firm focused on vertical software, digital health, and consolidations of cash flow positive businesses. In this episode of our podcast, we cover lots of great topics, like the importance of building long-term relationships with investors before you're raising capital, Rob's background story, and getting his career started at Goldman Sachs and Bain Capital and what he learned from this experience, going back to B school at Harvard Business School, and the story of how HourlyNerd started, how a Shark Tank non-appearance led to an investment from Mark Cuban that helped pave the way for their first fundraise, building and scaling the on-demand marketplace with an emphasis on quality and why they rebranded to Catalant, starting Asymmetric, and the firm's unique focus in terms of exclusively raising capital for their fund from family offices as LPs, what they are targeting in terms of investments and how they add value post-fundraise, go-to-market advice for startups, and when to hire your first head of sales, and so much more. All right, now a brief word from our podcast sponsor, Silicon Valley Bank. I'm excited to share that this podcast is brought to you by one of the strongest longtime supporters of the local startup ecosystem, that being Silicon Valley Bank, a division of First Citizens Bank. SVB serves innovative tech, healthcare, and life sciences companies, including 60% of CNBC's Disruptor 50 list, 72% of Forbes Cloud 100 list, and 48% of Forbes AI 50 list companies. With more than 1,500 bankers and relationship advisors and $42 billion in loans through Q2 2024, SVB delivers the right people, service, and resources to support your entire financial journey. Learn more at svb.com. All right, without further ado, here's my interview with Rob. Rob, thanks so much for joining us.
My pleasure. Great to be on.
I'm excited to talk to you because we got a lot to talk about. I like Catalant's such a great story, so I'm excited to talk about that. Obviously, I'm excited to talk about what you've been up to as an investor. And to kick things off, I actually want to talk about one of your most recent investments, that being Copley. So David and Sean, two of the co-founders of Copley, were on my podcast recently. And one of the things that I took away from that conversation that I thought, I don't know if it's always shared as much out there, is the importance of long-term relationship building with potential investors. From what I learned, you and Sean knew each other for a really long time. And then you got to know David and Mike, I believe. So it was just like, it was an evolving relationship to the point where maybe when they were ready to raise capital, that, you know, dating, or however you want to phrase it, was really consolidated into so I don't know, it's just, I want to talk about the importance of that long-term relationship building with investors.
Of course. I was just pulling up the first time when I was introduced to Sean. It was July 13, 2016.
Wow.
Basically, somebody interning at General Catalyst, who is our largest investor at Catalant, introduced me to Sean. I think I'd said that we were thinking about what our next head of sales was going to look like. And Sean and I met, and I obviously tried to sell him for a while. Ultimately wasn't successful in getting him to Catalant, but really formed a nice relationship. Was able then to bring him in as a executive in residence at Asymmetric. And then he decided that his next phase post, obviously a really good run at Klaviyo, was going to be to found a company. But the amount of kind of weird Boston back channels we had on that deal, we had three separate connections to Sean, other than him being in EIR with us. Rich Gardner, who was the head of sales at Catalant, then went on to run partnerships very successfully for Klaviyo, obviously knew David and Sean. our old general counsel, Shirley Paley from Demandware, was a great kind of backdoor reference on Mike, who'd obviously been at Demandware, and sort of had just all of the Boston ecosystems working on that deal.
So you have those, backdoor references, if you will. Um, so what should founders be thinking about? Like at what point should you start to have these conversations? Like maybe you think you might be going down a path of starting a company. Maybe you're starting to formulate some ideas, but like when, it's probably not a crystal ball answer, but
Yep.
just general purposes.
Look, I think when you get involved in the Boston or New York tech ecosystems, because they work exactly the same way, there's probably 10 or 20 firms and 1,000 or 2,000 people that really move the needle. And I would say to a young employee at a tech company, if you make a good impression on your founders, wherever you are in the org, your founders know the relevant VCs. When you're coming out and you want to start a company, that can be such a slam dunk. We have a wonderfully successful investment in a company called Evolution IQ down in New York. And we've just been all over every employee there as they think about what might be next, down the road. The acquirer obviously has all of them locked up for a while. Um, but when you have a great exit like that, it just creates this unbelievable wave of talent coming out into the ecosystem. And you have these pillar companies. In Boston, it's Klaviyo, and HubSpot. In New York, there's 25 different ones. That's really how I think the venture capital soup is made, is through these relationships that are formed when you're not founding, when you're not even thinking about founding. You get to know somebody, and then they decide that the day they decide to do it, if you've been tracking them and you knew their CEO, you knew their investors, that's really how it works.
It's all about your network. Get out there and meet people. It's got to
So,
be done. It can't
yeah,
be behind Zooms all day long. You got to get out there and meet people. So I am glad that people are doing that again, though. There are better events again. There's a lot
yeah.
going on. So
I think the other secret, Keith, is just doing a great job, um, just sort of doing a great job in your role, right? Like, there are obviously Catalant. We probably had 500 or 600 people who've worked there in the, maybe more, maybe 700, 800 who've worked there in the 12 years we've been running it. Almost anybody that did a great job at Catalant, I would back in a second, right? And we have backed Catalant people. We have somebody who is on our data science and engineering team now as the CTO of one of our portfolio companies. We brought in a gentleman that had been VP of sales at Catalant as the head of sales at a portfolio company that also had a great exit. And so these stories are 20, 30, 40 years, right?
and to your point, the founders of Klaviyo are back in Copley. So it just speaks volumes. And I love that they're, paying it forward too. That's so important. Like HubSpot did that. So, all right, let's rewind the clock. So where'd you grow up? What were you like as a child?
Oh my God. So I was born in New York City. I was raised in a town called Chappaqua, New York. Um, but really came from kind of Boston heritage and Boston DNA. My grandfather was from Dorchester. Um, Ordinarily, I say my grandfather was from Dorchester. And, born on Columbia Road, led to kind of a mixed set of affiliations. So we were more or less New England sports fans, plus the Mets. Um,
Ooh, okay. So
and
that was
that
a
led
rough
to,
World
some,
Series in
yeah, well,
'86
my
or
dad
whatever.
was an original Mets fan going back to 1962. I was born on September 9th, 1986. My mom had been on bed rest the whole summer, and the only thing she had to do to entertain herself, this is obviously in the pre-internet era, she's a lawyer, and so she would work during the day, and then she was rewarded, every night with a Mets game. So I think that was a complex one. And made it up here in 2010 when I left Goldman. I'd gone to Princeton, worked in New York for 2 years at Goldman Sachs, then moved up here to work at Bain Capital. So I moved up here in July of 2010.
All right, so those foundational years like Goldman and Bain, like what did you learn during that stretch?
Um, but look, Goldman was a really intense, serious place in the best of times, and I'd interned there in the summers of '06 and '07. Um, and it was just a very different experience in the fall of '08 when I started. Lehman failed, one of my first couple days there. And look, I saw unbelievable grit from the partners and the folks I worked with, many of whom are still close friends, and see them go on vacation with them and stay in their homes. I think Bain Capital was really a transformative experience in my journey because I never really been around a group of people that was that intellectually rigorous and intense and focused, but also incredibly down to earth. There were people at the firm that are still close mentors and allies and friends that have been so unbelievably successful, but are so down to earth. And that mix of being kind of a normal person, but being insanely smart, I thought was really cool. And obviously, I've never worked at a private equity firm in New York, but certainly when I got to business school and compared experiences with folks that had been at New York private equity firms, Bain Capital felt like kind of a place unto itself and just a really special group of people. And there were a handful of, those folks ultimately invested in Catalant and then, are probably about 50% of the capital behind Asymmetric. I think importantly, they really believed in me more than I even believed in myself. And if you go back to your original question, what was I like as a child? I was not, I was definitely a nerdy kid. It was this odd combination of very nerdy but very athletic. So I played baseball and basketball, played basketball through the end of college. Never sort of dressed for a varsity game, but I played in practice. I played in the JV team. And it was a weird juxtaposition of being kind of, typically high school athletes are some of the cooler kids in the school. I was definitely not one of those at all. But I think it taught me a lot about managing different phases and cycles of your life, because I had, my group of friends that were in the best math and science classes, and I had my group of friends that I played, baseball and basketball and ran cross country with, and they were totally different groups of people. And I think being a founder or a VC, you're constantly context switching. And you have an LP meeting, then you go right into a founder meeting, then you're taping a podcast. And VC is a role that, I think gets a lot of, surely VCs are never seen as the heroes of the story. They're almost always kind of the scapegoat in every situation, but it's a role that's certainly harder than I thought it was when I was a founder.
All right, so you went back to B school, Harvard Business School. So what led you down that path?
I'd always been curious to formalize kind of my business education. I did econ and finance undergrad. It was very theoretical. Obviously, Princeton econ is, a very, very good department. And we learned from wonderful people in that department, a lot who served in government, both on kind of the monetary and the fiscal side. Um, I felt like it was almost like a finishing school. So I'd done 2 years of private equity investing at Goldman, 2 years at Bain Capital. And I wanted to take 2 years to step back and think about business in a more comprehensive way. Private equity has a very limited lens on the world, which is we're going to buy a company for this much, we're going to improve it, we're going to sell it for hopefully 2 or 4 or 5 times more. Private equity does not have a lot of room for getting really deep into details. Sales versus marketing versus operations. Honestly, one of my favorite classes in business school, which sounds so lame to say, was accounting. I absolutely loved it. And I think there's a lot of funny stories about public company CEOs in the pre-Enron WorldCom era that claimed to not know very much about accounting. And those stories always ended really badly. And I think it's actually one of the things we've been able to bring to bear as a VC firm is really deep technical knowledge of business and finance, because things like working capital, which seem irrelevant, as you're building a rocket ship, can kill you. And certainly an area where we partner with amazing technical founders who are often amazingly technical. We're never going to help them on the tech side, but we can probably be pretty helpful on the traditional business side and allow them to be freed up and focused on the most important things.
All right, so you were at HBS 2012 to 2014, and I just feel like it was maybe a couple classes before you was this wave of when HBS became very entrepreneurial. It wasn't just investment banking and management consulting. There was, Birchbox and Runway and like these ThredUp, these companies were being born out of HBS. So you I don't want to say the golden age, but it was almost like the enlightened age of entrepreneurship is very important to all the schools at Harvard.
Totally. And look, I certainly Haley and Jen and James have all been unbelievable mentors to me and investors in various things we've done. And great partners. I think part of it was in the late aughts at HBS, there was such a steady stream of people heading to consulting and banking and private equity. And then in the late 2000s, you had that industry really collapse and basically stop making new hires. And so a bunch of, if the cookie crumbles differently, and obviously Haley's a VC now and could totally believe Jen and James are headed in that direction. But you could believe that all 3 of those folks end up never starting a company if they get an awesome job in traditional employment. And so I think, obviously I was on the, Pat and Peter and Joe and I were kind of on the tail end of that wave. But I think HBS in the late aughts, early teens started to see, our graduates can start companies that can become unicorns, can end up, public companies. And that was a big phase shift for the school. And I think obviously the school's always had entrepreneurship and, going back to the 70s and 80s, and there's unbelievable people that have founded companies coming out of there long before we did. But it was certainly the beginning of a new era at the school. And I'm, proud to have been part of that. And then also doubled back as a executive fellow for Scaling Technology Ventures for 4 years.
All right, so let's talk about Catalant because you started the company with your co-founders at HBS, originally called HourlyNerd. So how did that idea come to fruition?
So, so we had to start a class. So it's a class project, and the class project you had to start a business, and you were given. They broke the 900 teams, the 900 students into 150 teams of 6. They gave us $5,000 in about 8 weeks and said, "Go out and create a company. We've already incorporated it for you." And at the end of the class, if all the teammates will sign an agreement, we'll transfer over the IP. So nobody really took it seriously in the main as kind of a company, but we basically you early on in the class you presented to your peers, and there was a stock market where all the teams traded, and we were so proud of my little idea, which was something called Rent a Nerd, which we then had to call Hourly Nerd because we couldn't get the domain name for Rent a Nerd, believe it or not. And it was basically the idea that small businesses were going to be helped by MBA students to do small tasks, finance, accounting, go to market, operations. And it was a pretty little one-page business plan. And I sent it to my parents that night, and I said, I think this actually could be really successful. And we presented and we traded down to last. We were the last stock out of 150 teams. And I think at that point, all of us had combination of kind of athletic and military backgrounds. We just got annoyed and we said, there's no way we can possibly be the worst team in the school. And we just went out and sold like crazy. And I think the stat was at the end of the class, the 150 teams had created $35,000 of revenue, and we were 29,000 of the 35,000. The other 149 teams had created 6,000. So
No
we trade up.
way.
We're obviously the highest stock by a lot. Then we don't win the judges contest. So there's judges, a bunch of VCs and alumni. We come in second. And the judge in our section, a guy named Bob Doris, who's still on the board of Catalant today, comes over to us and says, I really think you guys could turn this into something. I think, removing traditional barriers to consulting could be really cool. If you decide to raise money, let me know. So my co-founder, Pat, told him, we're going to bootstrap this thing. Thanks, but we're not going to need any venture funding. But he gave us his card. So we head out to California a few weeks later, right at the end of our first year. We through, Princeton and MIT and Harvard alumni networks, we're able to book 30 meetings with VCs. We get turned down in every single one of them, laughably turned down. We weren't. The other thing was the complexity was we all had summer internships. So I was at that point sponsored by Bain Capital. I was going back. I was working at Michael's craft stores full time in Dallas. Pat was working for Anheuser-Busch in Belgium. Peter had an internship. Joe had an internship. So VCs here, 4 non-technical guys, all from consulting and banking and private equity, just a horrific, 0 out of 10 pitch. And some firms were pretty mean to us. They said, not only are we not going to fund it, but you guys shouldn't even start this company at all. So we get turned down. We have 29 meetings Monday through Thursday. We get turned down all of them. Friday, we have a meeting with Bob Doris at his office in Sausalito. And we almost considered canceling. We said, this guy's just going to say no. We could come home on Thursday, back east. And we get into his office. We meet with him, and he says at the end, well, I think we're interested. And we had no idea what to say. We didn't know what you say next when the VC's interested.
Like what?
So I said, what would be your capacity? And he told us a number, and then he had a criterion, which was he wanted at least one other person to invest that was not friends or family, professional investor. So we spend the entire summer, this is probably something like May 28th, May 29th. We spend the entire summer trying to get another investor. We totally strike out. We apply to go on Shark Tank. Joe Miller, our co-founder, had the idea, why don't we go on Shark Tank? We get accepted. We get the interview, we get the taping date, and it conflicts with our second year of business school. So we said to HBS, can we Can we skip a couple days of class to go to this? And they said, absolutely not. You either have to drop out or go to the taping. So we dropped out of Shark Tank. We stayed in business.
Right. Right.
And then we basically had the idea to email Cuban directly. So I sent him an email, found his email address on the internet, and just sent it over, expecting nothing. Writes
Yeah,
back.
don't you think there's like a field of people monitoring his emails? Like not like you
You would
sent
think.
Mark at.
My belief is that he reads everything himself,
Hmm.
and so he
That's what I've
responds.
heard.
And within a couple hours of email back and forth, he basically was in. And we went back to Bob and we said, we do have one person willing to invest, and he'll probably take almost the whole round. It happens to be Mark Cuban, and he was just blown away, obviously. And then the HBS story just kind of continues through it. So our first customers were folks at the Exec Ed program who ran kind of mid-sized regional companies. That fall, we got introduced to two HBS grads, Dan Nova at Highland Capital and Bill Hellman at Greylock, actually by one of our classmates, Robbie Greenglass, who I'd known briefly before business school, and then was one of our classmates in business school. Dan and Bill led the Series A, and Dan's been on the board now for 11 and a half years and become an incredibly close friend. And it just sort of, the Boston network, I think there was one point where we had, we met with probably every single firm in Boston, and we were lucky, obviously, to get Highland and Greylock and General Catalyst. It's just such a small town. So I'll run into one of them at the Quinn or something, and somebody will say, how do you know him? I say, oh, he's a friend. How'd you meet originally? We actually led the Series A in my company 12 years ago.
All right. So once you raise this initial round of capital and you're like, okay, we're going to actually build this. Like, how did you do that? Like, so did you step aside from HBS? Like, how did you get things going?
Well, we continued what we were doing at HBS just because we felt like it was one of the world's best accelerators. We were just having an unbelievable time. I still felt like we had things to learn. We were taking wonderful second year classes with great people. And we felt like we could do a great job of running. We were able to set up our schedule where we were running the business Wednesday through Friday, and we had class Monday, Tuesday was my schedule. And Pat was on the opposite. So he had class Thursday, Friday, and was available Monday, Tuesday, Wednesday, because you can sort of set up your schedule that way. And, just a wonderful path to go. And it was only, we were really only in school from September through April, and we were getting advice. So basically all of our independent work, we wrote it about the company, and it was just a wonderful experience. It was kind of the world's greatest accelerator.
And did you always have this idea that, hey, we're here to disrupt, the McKinseys, the Bains, the BCGs? Like, was that always kind of the mission and focus?
We grew into that mission and focus. We started out and it was way, way more prosaic than that. It was just, we really want to help small businesses. And then we saw the craziest thing. And this is why I think it's so important. So many people love building in stealth. And I'm so much more of the opinion that you should build in public, because when you build in public, the customer can come in and play with your product. So we put it out there, and it wasn't explicitly SMB focused, but it was quite obviously not for enterprises. It was called HourlyNerd.com. You checked out with a credit card, and all of a sudden we started to see a bunch of signups from enterprises. So somebody would sign up with their Gmail account, and they'd say Coca-Cola, Gmail account, Anheuser-Busch InBev. So we reached out to them, and this is how real customer discovery can happen in the wild. We reached out to them and we said, how is it that you ended up on our website? They said, I'm so frustrated by all of the paths through which I might be able to, I'm so frustrated with, how it works internally to get a person, or to, the McKinsey, $2 million and a team of 8 for 6 weeks. And just a wonderful kind of a wonderful episode in customer discovery. Honestly, if we hadn't put the product out there and we built it in stealth and secret, we'd probably still be working with small businesses and still be a tiny company.
All right. One of the complexities of building what you built was it's a marketplace. So you needed the customers, and you just talked a little bit about the customers, but these customers have real problems, right? These are not, I'm trying to buy a pillow through Etsy problems, marketplace problems. This is Fortune 500 problems that they would go to Bain or wherever. And then you've got to get the experts that can actually deliver on that. And then as HourlyNerd or Catalant, you had to make sure the quality was there of what the marketplace was delivering was what was expected.
Yeah, and that was the biggest question we had, and certainly the biggest question prospective investors asked and customers have asked for 12 years now is how do we know the quality is going to be any good? And I'd say first, having done a lot of work with McKinsey and Bain in my private equity life, their quality is not always so good first. And then second, it's something that happens with the magic of the marketplace. When you have, tens of thousands of customers using hundreds of thousands of people, very quickly the cream rises to the top. And we've developed these days at Catalant this fantastic algorithm where all of that happens automatically. So if you think about what typically leads people to believe in quality from a Bain or McKinsey or BCG, it's typically, feedback and reviews, but there's a lot of weird human biases that go into that. And I think we found that when you outsource that to the machine and it's true customer feedback, aggregated over many, many observations, that's great. But then also these days we have pretty fancy algorithms that figure out based on kind of all the words in somebody's self-description, their resume, and all the work they've ever done, how much that looks like this project size. So you're sifting through hundreds of thousands of resumes virtually instantly. And that's, if you think about how staffing happens at the traditional consulting firms, it's a much more sort of serendipitous process of, that this person has some availability and they want to do a project in Tennessee. So it's not always, a very tech-driven path to, the best possible team.
Yeah, true. Availability on the bench. We got to get this person staffed versus expertise.
Yeah. Or they want this development assignment, or, their significant other lives in this city. It's very rarely a AI process of kind of matching all of the best, the most compatible terms.
All right. So you went on to continue to raise capital, which it just seemed like, how does that work? Meaning, like, you raised a lot of capital and it was just continuous. It was almost yearly for a good stretch. So were you always just raising, always talking to investors, keeping them informed of the business, its growth, and, because you knew you're going to raise a C round next year and then the D, then, it just seemed like it was continuous.
Yeah, it's funny. Almost never was it the case that we went out into the market and raised money. And I say this to our founders, the best companies, I think, never have a fundraise. They never have a data room. They're just kind of continuously getting to know folks. And at some point, some of those folks indicate a willingness to invest. So I think our Series C is a great example of that in the end. In the end, we chose to work with General Catalyst, and we worked with David Fialco there, and Adam Valken. We'd gotten to know them, 3 years earlier before they actually invested, and we just continued spending time with them. They were, their office was obviously in Harvard Square, right down the road from HBS, and we'd be in class and get a note from David or Adam saying, come over and hang out. And when it came time, another firm in New York actually came in and tried to preempt our C. We called David and Adam at that point, and they, popped up, and we were able to get it done relatively efficiently.
And what, like, you eventually branded the Catalant. What was that process like? How did you go about? I'm always fascinated by branding.
Yeah. So look, we found that. So we found that customers absolutely love the value prop. HourlyNerd was very much an impediment to diffusion within the enterprise because it was an unbelievable value. But basically, it was difficult for an executive to walk in and throw something on the table that kind of had the HourlyNerd brand on it. And at the time, Jeff Immelt was running GE, and he told us, I would love to not only push you all throughout this organization, but also, push you out to a bunch of other Fortune 100s and Fortune 500, leaders I know. It's really hard to do it with the HourlyNerd name. So he challenged us, and we were emotional about the name. It was a company we founded. We were obviously proud of it. He said, if you guys rebrand, I will throw a dinner for you in my office with the number 1 or number 2 at 15 Fortune 100 companies. Jeff Immelt's a man of his word. He told us he was going to do it, and he did it.
And he did it?
Well, so we had the rebrand, and We were not trying to hit a walk-off grand slam with the rebrand. We just wanted something that was neutral and safe and just didn't do any harm. And in that way, a lot of people when they do a rebrand project or a branding project, they want it to be great and new and exciting and dangerous. All we wanted was something that sounded corporate and almost not bland, but safe. And we looked at things like Accenture. So Accenture was obviously the Enron was the the Arthur Anderson consulting arm, and Verizon is a great example where Verizon's kind of a meaningless world, but when you were trying to rebrand, one of the Bell descendants, that was a great path. Um, and so that was yeah, it was. We did it in the summer of 2016, and the next week, just the enterprise interest just went off the charts. So we worked with some enterprises as HourlyNerd, and the minute we did that rebrand, the enterprise leads kind of quintupled, and we were so happy we did it. It was really
Wow.
thanks to a large extent, kind of thanks to Jeff, because I think there were a lot of people telling us not to make the change, and he really pushed us hard on it, and he was totally right.
I hope you are enjoying this interview. Just a brief word from our sponsor. As a longtime champion in the local startup ecosystem, Silicon Valley Bank supports innovative companies with the solutions and financing they need through every stage of growth. With more than 1,500 bankers and relationship advisors and 42 billion in loans through Q2 2024, SVB delivers the right people, service, and resources to support your entire financial journey. Learn more at svb.com. That's so fascinating. All right, so you scale Catalant. Um, I guess where did it land? It's still operating today, of course, but at what point did you decide, hey, I want to get back into being a VC?
Yeah, so Catalant's a wonderful business today, well over 100 million of annual consulting projects. Pat, my original co-founder and former co-CEO, now sole CEO, is running it. I'm chairman of the board. Still have a wonderful group of people who invest in it. Some of them, or all of them, basically asymmetric investors. As we got into 2020, we had the pandemic, and it turned out to be a really positive thing for the company where we just saw a huge, over the course of the summer, it was in the spring was slow, but in the summer of 2020, I think a lot of customers for whom the in-person had been an impediment, obviously most people in Catalan are remote, all of a sudden that wasn't an impediment. And so we started to see kind of tremendous growth in customers for whom the in-person on-site had been a problem. And we got into the summer, and I started thinking about how I wanted to spend the next 10 years. And a lot of this was just a testament to the strength of the team, to Pat and to Jake Simpson, who was the CRO then, to Ben Zlotoff, who was the CFO then. And I just sort of said, I think my best and highest use of the next decade or 2 decades of my career is not as a founder CEO, but it's being back in private equity investing or private capital investing, obviously venture in this case. And it was really difficult. It's hard when things are going really well for that to be the right moment to walk away. But I kind of knew that if I didn't leave or transition to chairman in the summer of or spring of 21, it was something we started talking about as early as 2018, 2019. But in some sense, I was just having too much fun. And I think one of the things that I loved about Catalant, and I still love, and I obviously still go to events and hang out with the team, was just the people. And when that was taken away in the summer of 2020, I realized that for me, the Catalan experience had been about the employees and the experts and the customers more than the business idea. Even though it was my idea, I just loved being with all the people. And when that was taken away, I realized I didn't love the role as much as I really loved the investing side. Um, and it was nice, without the pandemic, I never would have gotten that isolation of people versus product. So at that point, went to a handful of board members, and at this point, a really important person in the story is a guy named Mark Nunnally, who'd been co-head of Bain Capital when I worked there, and I'd been lucky as kind of the extreme low guy in the totem pole to get a lot of direct exposure to him and a handful of portfolio company instances. I just laid out my dilemma for him, and I said, I think I'm losing steam a little bit here. I might transition to chairman and just go work at a venture capital firm. And he said, well, you've been a CEO for 8 years. I don't think you'd find that super fun. What if we started a firm together? And, at the time I thought it was just sort of idle chatter. I was out at his house out in Dover, Mass. And I was super inspired, but I wanted to be emotionally cautious because who knew what was going to happen next. And he certainly meant it. And we spent a couple of months in the spring of 21 talking to a bunch of families in Boston. And I think, there'd been a trend in the late teens and 2020 and 21 where a lot of the best firms in Boston had either migrated way upwards in fund size or sort of migrated to California, or they'd kind of done both at the same time. And so there was we felt, and I still feel this today, kind of a market gap in New York and Boston for a super hands-on, operationally focused firm that does sort of pre-seed and seed. And a lot of those firms, for better or worse, the ones that I'd pitched in 2013, 14, 15, had really died out. And so we decided that we were going to build kind of a new kind of firm that probably took a lot of private equity heritage and DNA of kind of bottoms up working with companies, had an extremely patient capital base. So even today, all of our LPs are family offices. We really work with people that have a 20, 30, 40-year time horizon. They're not worrying about meeting operating budgets of universities or pension obligations. We want people who are almost, it's not exactly a requirement, but I think almost all of our LP dollars are ultimately going to be donated. And that creates a favorable flywheel where we can do deals. We have such a tight group of LPs. They are themselves the former heads of private equity firms and hedge funds and real estate firms. I often say we're the only private investment firm in the world where every LP is smarter than the GP. I think that's probably true nowhere else. And every one of our LPs is just experienced and kind and hands-on. And I think they partnered with us partially because they thought it would be a good way to compound their capital, and partially just because they're wonderful people and they wanted to be part of the story. And I reach out to them and lean on them, and the whole team does, both for kind of how should we think about this investment, and also who do you know at this prospective customer, and do you want to come onto the cap table directly? And it's been a wonderful experience building this. Today, the firm has folks among New York, Boston, and San Francisco, and we have an investment team that's all partners. So one of my great frustrations as a young founder was, your time is your most important resource for anybody in life. But if you're a founder with limited burn, it's really your most important resource. And, in your first meeting with an asymmetric employee, that person will be a partner and they will be a check writer. And look, we don't do the meet you twice and send you a term sheet. We like to form relationships over time. But each of those meetings, we're told by our founders, is incredibly high value in sort of advancing the story. And we try to add value even in the situations where we aren't able to make an investment.
I didn't know that was your fund was raised by family offices, which, looking at the market right now is brilliant.
Yeah, look, the family offices, I think, have upsides and downsides. Obviously, traditionally, I think pension funds and endowments have been a great place to raise. What I just love about our folks is we're plugged in with the decision maker. They are truly solving for compounding over decades. And I think, look, what's nice is none of them have bucketed us in as you are my Northeast pre-seed and seed $2 to $5 million check player. They just think of us as kind of an absolute return vehicle. And I think it's more difficult when you're in E&F land, and I'm not ruling it out. In Fund 3 or Fund 4, we might indeed work with some, proper institutions. But for now, it's just been great to partner with people that have kind of an unlimited time horizon and are very focused on absolute returns.
Now, when you were starting the firm, if I did some research, of course, before our conversation, and so you were actually doing some investing before starting Asymmetric. Like you invested in Gong, I think, and so you were already, you had the background before Catalant of private equity. So stepping into this role was just like a natural transition for you.
Yeah, I think in certain respects, certainly I'd never been a professional venture investor, but yes, I'd invested in Gong and a handful of other companies that had gone on to some pretty good success. A lot of differences. Private equity is largely about kind of not making mistakes and kind of keeping things between the bumpers. And obviously, venture is about swinging for the fences and finding the true outlier ideas and the true outlier people. But there's certainly a lot of shared DNA, and I think the best thing I took away from Bain Capital in this regard was just the concept of risk and return. And look, we're in the business. More than anything else, VCs and all private and public capital managers are in the business of modulating risk. So folks, they could be the U.S. Treasury pays a pretty good rate these days, and it's pretty safe. If somebody's going to take money out of U.S. Treasuries and give it to you to actively manage, I think you have to tell a really clean story in your own head and then to them of why the risk reward is a better outcome than the risk free rate.
So how do you view asymmetric as, there's obviously, the capital aspect of what your firm can do, but like post investment, like how do you partner with your founders?
Look, we're never going to do a single thing with them on technology. It's not our sweet sauce, and I think it's not our sweet spot or our secret sauce. We work with them to do the nuts and bolts of company building. So we free them up to focus on building product and understanding what the customers want. And we will run operations, finance. We'll partner with them in building a team. Just this week, we have one of our teams from London living in our office in New York, and we are helping them hire their go-to-market team. My colleague Nancy comes from an operating background after private equity, after investment banking. And so I think she and I have a pretty refined sense of what a good sales leadership team should look like. Look, I think the other thing that doesn't get enough press, because it's certainly not glamorous, is capital allocation. There's this kind of, people always think you should raise money every 24 months. And the reality is some businesses should be raising every 9 months, and some businesses need 5 years of runway out of the gate. And a lot of it comes down to, it's not just a rote, what's our annual burn, multiply that by 2, go out and raise it. It's actually, what are the metrics and the key milestones we're going to need to prove before unlocking another tranche of capital, or maybe never unlocking capital again. And I think founders, including me, are just so broad brush in just continuing to inertially roll over whatever org structure they had, versus this is the discrete set of things we're trying to prove by virtue of capital.
All right. So what's Asymmetric focused on? Like, what's your lane? Is it tech, vertical, agnostic?
Look, we at our core, we make private early stage investments that sort of piggyback on the tech ecosystem that is currently being built. We do that probably in 3 key ways. The first is pre-seed and seed, traditional venture investing. Most of that is in vertical software. We found that data moats are very interesting in vertical, much less so in horizontal. We saw that in Evolution IQ, and we're seeing it in Counsel, where when you have a specific data set and you can drop AI on top of that data set, that is very interesting as a source of moat, which historically has not really been present in SaaS. The second area, we do a lot in healthcare. Some of that's kind of proper healthcare IT, some of it's really tech-enabled services, and we found that once again, that data and new technology are changing healthcare in really cool ways. And then the third area that we do that not a lot of other people were doing 3 or 4 years ago, and unfortunately a lot of people have started to piggyback into, is kind of this idea of SMB consolidations, where you have a customer segment that can benefit massively from technology, but it's going to be really hard to sell directly into them, so you just buy the whole P&L. So it's almost like a vertical integration of software, and that's an area where we've had tremendous success, whether it was in a Latin American e-commerce roll-up, or owning a fraction of one of the preeminent iPhone application consolidators. And that's an area that's fun, and I think allows the team to flex some of our kind of legacy, lower mid-market private equity heritage.
Yeah, what are some good portfolio examples to share?
So a lot of companies doing really well in the portfolio. One that I alluded to a few minutes ago, Aleva, basically owns a bunch of e-commerce sellers down in LATAM. A lot of them are on the Mercado Libre platform. Some of them sell offline and directly through their own kind of virtual storefronts. That company's had fantastic success. Counsel is a virtual primary care business started by one of the most phenomenally talented people I've met, Muthu Alagapan, a physician and also an AI researcher, and also for a time was kind of the analytics, sort of volunteer analytics guy for the Sacramento Kings and the NBA. What he's doing is actually basically over the long term really removing physicians from medicine and making all of the, ideally at scale, almost all of the judgments and the decisions rendered by AI. It's a fantastic product that I use today personally and have had great outcomes with. And if you think about how messed up the healthcare system is, a lot of it is that the sort of receiving line for relatively mundane tasks is an in-person visit to an urgent care, or in some unfortunate cases, an ER. And if you think about all the extra cost that drives in the system, having somebody go to the same place for kind of a gunshot wound and a sore throat is outrageous. But the system hasn't given people, obviously, of course, the urgent care is a better choice than the ER, but there are some people who just use the ER as kind of their primary care, particularly in a world where they haven't been able to establish a relationship with a primary care physician. If you think about why that they haven't, is because provider ratios are so stretched. We have so few places in medical schools that when I go on the Mass General portal to try to make an appointment with my primary care, it might be 60, 90 days before I can do that. And so the consumer who doesn't feel well today, this is sort of where the urgent care industry came from. But even the urgent care industry, in a lot of geographies can be hard to get an appointment. And there are a lot of things that, I had a cut on my hand and I wanted to know how serious it was. I just went out and sent a photo to the council site and they were able to kind of advise me and remotely prescribe an antibiotic. We really think medicine is going in that direction, not only in the United States, but if you think of other places in the world like sub-Saharan Africa, where sort of access to medical care is more difficult, being able to do it all sort of by a smartphone, except for the most acute cases, is actually a super interesting unlock.
It's incredible amount of disruption that's going to be taking place, hopefully, in healthcare. All right, so you mentioned helping out. One of your portfolio companies is in your New York office, and you're helping them with their go-to-market hiring and plans. So what do a lot of founders get wrong when it comes to thinking about their go-to-market approach?
Okay, I think you have to learn. So there's sort of two phases. You have to figure out why your customer is buying. And to me, the simple unlock on why your customer is buying is tell them the story of a P&L driver that's going to increase by a factor of 10, or decrease if it's cost by a factor of 10x what you're going to charge them. If you get that story down and you're solving the most important issue they have on their plate, they will buy from you. If you're not solving the most important issue, or maybe the second most important issue, you're not going to get momentum. So that's what we really, there's this expression of, is it sort of pain medicine or is it vitamins? To me, I saw this expression in somebody's deck recently. Is it Advil or is it kind of something way more important than that? Because if you're solving a gunshot wound for somebody, that's really important. If you're giving them Advil or sort of pain medicine, that doesn't help so much. I think what we found, particularly when you're selling to anything above regional enterprise, is if you're not solving a problem that is top on their board meeting dialogue, you're not going to get any time of momentum. And so when we're looking for B2B, and almost virtually all we do is B2B, when we're looking for something in B2B, it's got to be solving the most important topic.
And what about the initial building out a sales function? Like when do you hire your first salesperson? Like when do you know?
So I think there's a great phase. You don't want to go away from founder-led sales too early, because the founders have to be close to the product and to the customer. I think part of the challenge though is if founder sales go too long, two things happen. One, if you're the founder CEO, you always have more important things to do than the next customer meeting or the follow-up. You have investors paying you, you're hiring, whatever. And the second thing is founders tend, if there's somebody who's been able to raise any money, they tend to be pretty good charismatic storytellers. And they can create sort of excess demand for a product. We always used to say, we'll know when we're successful at Catalant, and we still haven't gotten there yet, when we can hire truly dumb people on the sales team. And even today, everybody on the Catalant sales team is really smart, because it's a very, it's a complex sale to really discerning buyers. And when you meet, a larger company where it's just this totally coin-operated thing, you can almost imagine an AI bot doing the sale. That's when you've really developed something that can, get a really repeatable flywheel going. So I tend to think there's also two types of sales reps. There's sales reps that are snowplows, that are people you trust to go out, and then there's people that are coin operated and they're not going to snowplow well. And the big question, we hired a lot of people that came from Salesforce and Workday, and they were wonderful people, but they had trouble selling when they didn't have the surround sound of product marketing and customer testimonials and years of kind of a organic marketing flywheel. I think you can tell if a rep's like that when they ask you about the collateral suite, and they're going to need kind of fully built out product marketing and objection handling. That's not your snowplow rep. That's a fantastic scaler rep, and they're also not interchangeable. So in the same way, you never want to hire a scaling rep at the snowplow phase. A snowplow rep at the scaling phase is also probably not an ideal fit because they typically want to kind of do their own thing. And so you actually sadly see your snowplow reps start to become less excited about it once the process becomes routinized. And so at this point, the Catalant process is pretty well defined. And we have that in a lot of our other portfolio companies. As you get to kind of like the 5 to 10 to $15 million revenue point, most things are pretty are well scripted at that point, and that's usually the point at which a snowplow rep should probably would probably have more fun in a different setting.
I like that analogy, the snowplow scaling type of rep. What about hiring your first like sales leader? Like different phases of a company probably needs different levels of, do you need a chief revenue officer right away, right? Like that
Yeah.
type of thinking.
Look, we've had a lot of great leaders at Catalant. I think sales is an area where we really never missed. Look, in the same way you have snowplow reps and scaling reps, I think you also have leaders of sales that hit that. And so Rich, who was our first sales leader, was just fantastic at being able to understand what the customer wanted and how we built an org around that. And then Rich only transitioned over to marketing because that's what he wanted to do. And I think long term, obviously, he's been unbelievably successful in the partnership phase. We went from Rich to Jake Simpson, who'd had a tremendous amount of success at PTC and Onapsis and a bunch of other companies. Jake was kind of the perfect person to take over the baton, which I was begging Rich to keep, and he was just pushing. And Jake did just Jake came in September, October of 2017, and just did a wonderful job taking us to the next level and really built kind of an org design against that. And I think it's almost unheard of in startup land to have kind of for the life of the company, substantially 2 heads of sales, both of whom worked out, both of whom were there for 4 or 5 years. It's really special. I think Jake might have been there for 6.5 in the end. Just having folks that come in and can elevate their game as the company game elevates. I think that's one of the most challenging things in startup land. And we haven't done everything right at Catalant, but I think at the executive level, by and large, the hiring has been fantastic. And a lot of those people, all of them have obviously become good friends for life, but they were each so special during different phases of the company.
All right, so I think it was towards the end of last year, you published an article on Crunchbase. What I wish I knew when I started a company. So what are some key lessons learned from that?
Oh my gosh. Look, I think using capital in the right way, which is to fund customer discovery until you figure out exactly what you're selling and scaling. I think, look, being very realistic about how far you can take an individual in a leadership role. The person who you can hire when you're a pre-seed company, in almost every case, is not the right person for the role at the Series C and the Series D. We were unbelievably lucky at Catalant to have people who were able to uniquely span that. And I'd say the most, if you said, tell somebody in one sentence the most important thing for starting a company, it's find the customer's most burning pain point and solve it for them. And if you look at, every product that's been successful, whether B2B or B2C, it's hit a direct point. And I love the story of Uber. If you were in Boston or San Francisco, New York's always had good cabs, so it's a nice thing in New York, but cabs are great in New York too. Boston and San Francisco cab scene was just horrific. If you were in Boston, particularly if it starts snowing or raining or it's late at night or it's early in the morning. I once missed a flight to a conference in Back Bay just because none of the cabs called back. I think this was maybe a couple weeks before Uber turned on in Boston in 2011. And I literally just missed a flight to the airport because none of the cabs were, in Back Bay at that point. And, obviously the legacy industry there has been so held down by a bunch of regulatory type stuff. And in the personal transportation arena, Uber solved your most pressing problem, and they solved it extremely well, and they solved it at a reasonable price point. So anytime your customer would happily pay 20, 30, 40% more for something, that sort of suggests that you found the pain point right there. When it stops being about cost and it starts being about you're the only unique way that this problem can be solved, that's pretty special.
All right, 3 apps you can't live without, can't be Slack, email, or calendar.
Uber. I fought WhatsApp for a long time, but as we've grown our international founder base and our international LP base, people outside of the US do not use SMS and to a large extent or iMessage, and they largely don't use email. They're all on WhatsApp. It was something I first encountered in business school, obviously a very international group. Um, and then the one I've been using a lot lately is called Granola. They currently, at least unless they've updated it as of late, as of last time I checked, they didn't have an iPhone application. But the seamless, if you think about, I hate taking notes, but we have a kind of internal note-taking requirement for founder meetings, and Granola generates these perfect summaries with one click, and it's there listening. You don't have to install it with anything. It's perfect, and it's just a great way to get summaries of meetings. And I hope they have an iPhone application really quickly.
Well, there's definitely a trend brewing for granola because I've been hearing it as one of the three from multiple interviews. So
Totally.
it's obviously solving a pain point that people will be willing to adopt or pay for. So,
Totally.
what do you like to do for fun outside of work?
So I have a wonderful dog. A lot of time with him. Golf, cooking, skiing. Of late, I live in the West Village in New York, and I didn't notice this when I was living uptown. I think because there just aren't as many. The flowers this spring in the West Village have been just unbelievable, which I think has probably also contributed or been the same root cause as also one of the worst allergy seasons ever. But of late, I've been taking a lot of photos of the flowers in the West Village. Certainly travel. We're lucky we have just a wonderful LP base in London and a wonderful group of founders there. So I get to go over there probably every 6 weeks or so. And London's a city I expect to spend a lot more time.
Well, Rob, thanks so much for taking the time to walk us through your background story. Obviously, all the great work that the team continues to do with Catalant, and obviously the all the great advice and investments that you're making.
Wonderful. Great to chat. And thanks for everything you do in the ecosystem.